My next guest is expecting all of this bullish momentum to continue. He says investors should look past any soft patches and focus on what's working. Jim Caron is CIO of Cross Asset Solutions at Morgan Stanley Investment Management. I'm not saying you're recommending Bitcoin. Maybe you are. I don't know.
I'm not.
I don't know.
It's not part of it.
Palantir. No. What is driving this momentum? Is it the little fear and greed index is back to, I think, greed or extreme greed levels. But what do you think is really going on here?
So in some cases, it's almost like the dog that didn't bark, right? So what I've been saying since the beginning of the year is that there are a couple of things that are going on in terms of policy. One is deregulation, two is tariffs, and three is budget and taxes. Everybody focuses on tariffs. Tariffs are a negative. Tariffs are a tax on profit margins and a tax on earnings. But the other two are positives, right? So the deregulation is a positive. It reduces cost. And also the tax and budget program, now that we have clarity on that, now that we know what that is, also a cost reducer. So
for businesses.
For businesses. So effectively, you have tariffs on one side, which are a cost, and then you have the cost reducers. Everybody focuses on the cost piece of this, which is the tariff part. So what I think is happening is people's forward look past the soft patch, potentially in the second half of this year, is that there will be better operating leverage for earnings going forward, and people are willing to buy into these multiples here.
It's poetic. We're saying this as the S&P has just hit another record intraday high, so congratulations to them. A lot of people would say, well, earnings, the estimates in the back half don't look as strong. We think inflation's going to be stickier. I mean, speak to some of those concerns that others on Wall Street have. Yeah,
look, I mean, I get it. And I am in the camp that we are going to get worse data over the next 6 months. I think that the growth trajectory is going to be a bit lower. I take the Fed's estimates, I think that they're on the right track. I think inflation might even be a little bit higher. The question is will it matter for asset prices? And I think a lot of that is baked into the cake. And the reason why I say that is that if you look at people's growth estimates or even earnings estimates from the start of this year to where they are today, it's lower still. So people have taken into account the tariff shock. But with the recovery in markets, and like you just said, we're making new all-time highs,
right.
They're not increasing their earnings projections. They're not changing their growth forecasts at this point because we still have tariffs and the uncertainty that's still looming. What I'm saying is that what if the growth shock and what if, therefore, the earnings shock isn't as bad,
right.
Then there's upside surprise.
I look at Delta as an interesting kind of case study and in many ways a barometer, and they were kind of a canary in the coal mine, both for the soft patch and now maybe for stabilization. But even in reinstating their full year guidance, it's a few bucks below where it was supposed to be in January when they thought they were going to have a record year. So you feel like, okay, I guess it's just all a game of expectations. It's not as bad as it looked in April, but I wonder if that still is enough to kind of,
Well, look, I mean, if we think about the Fed's forecasts, right, everything has to do with, well, we have tariffs, the impact of tariffs. We're still a little bit worried about this, and I am too. I think this is absolutely a risk. But like you just said, it's a game of expectations. What if it's not as bad as expected? What the markets are having a hard time struggling, and I love to use this line, is that the markets keep disappointing to the upside. Because if you just look at the cost point of this, which is the tariff point on this whole thing, you're forgetting about the cost offsets, which is the deregulation and the tax and budget. Now, one of the things that people talked about in the first half of the year is, well, businesses don't have clarity. They can't make any decisions. Well, I think the first half unclarity is giving way to clarity in the second half of the year.
Even with big question, when we hear now the copper tariff is 50%, pharmas might be 200. That doesn't rise to the level of uncertainty that you would say it's like capital U uncertainty?
No, because the reason is that now we understand that there's a pathway to get a deal done. In April and potentially even in May, we didn't know that there was a pathway. We just thought, okay, universal tariffs, these are the big numbers, this is really bad. I can map that to bad earnings and to a bad GDP expectation. Now what we're finding is that there's a template between, say, the UK, China, potentially even Europe, that there is a pathway to get some type of resolution through these tariffs. So that reduces, so let's say uncertainty with a little u as opposed, I like the way that you phrased it. And I think that's what it is. And that basically reduces risk premia, and it allows people to think about, well, then if we do get past this and if we don't have a recession, and yes, the markets are expecting a slowing in growth and a rise even a rise in the unemployment rate and a rise in inflation, but if it's not as bad as people think, then let's start talking about 2026 already, right?
Exactly.
And now you start to think about operating leverage. The tariff, which is maybe that one-off price shock, inflation then starts to come down. we're in a very, very different ballgame at that point.
I like it. Just going to leave it right there, Jim, on a positive, and a constructive, and an upbeat, whatever you want to call it, on that note. Jim Caron.